Welcome back to the deep dive. Today, we are undertaking a pretty complex mission.
I think that's putting it lightly.
Yeah, we're not here to offer, simple financial planning tips or budget hacks. We are diving deep into the architecture of decision-making itself.
Right.
We call it the Allocator's Dilemma, and it's this fundamental, often painful psychological conflict that really determines whether you live a life-chasing consumption or a life-building, true compounding wealth.
That's so true. I mean, if you've ever gotten a big raise, only to look at your bank account a few months later and wonder where it all went.
Because your expenses just magically rose to meet it.
Exactly. Then you are caught in that consumption-based existence. And our deep dive today is designed to give you the blueprint to shift out of that. We're exploring the entire cognitive structure, the psychological blueprint that's required to move from merely spending to strategically investing.
So our mission isn't just intellectual, it's almost existential. We want to understand the restructuring of, I think you called it, the cognitive architecture that's necessary to move from a scarcity-driven survival mode
Constantly reacting to bills, to debt.
to an abundance-driven growth mode where your capital is actually out there working for you.
And to do that, we've blended insights from, well, a lot of fields. Behavioral economics, neuropsychology, strategic resource allocation, even advanced human capital theory.
So we're going to unpack the math of return, like ROI and opportunity cost.
For sure. But the real power of this conversation, I think, lies in understanding and then overcoming the biggest psychological barrier we all face, that immediate bias known as hyperbolic discounting.
That sounds like a war waged entirely inside your own head.
It is.
Okay, let's unpack this. And let's start where all good allocation begins, with the objective, fundamental economic mechanics. Before we can even touch the psychology, we have to draw a clear line in the sand, using the language of finance, between an expense and an asset.
Exactly. Because in the world of business, this distinction isn't just a vague idea, it's codified. It's written right into the language of financial statements, the income statement, and the balance sheet.
And the idea is that the sophisticated allocator applies that same rigorous accounting separation to their personal life.
That's the goal.
Okay, so let's define the first side of this dichotomy. Spending, or what accountants would call an expense. In the simplest terms, this is swapping your capital for some kind of immediate utility, right?
Immediate benefit. You get something right now, and then the money is effectively gone.
Like your rent, your groceries, that coffee you bought this morning.
Or that impulse purchase that gives you that quick dopamine hit. From an accounting perspective, an expense gets recognized immediately on the income statement. It reduces your net income, dollar for dollar, right now in this period.
So the key characteristic of spending is finality.
Finality, that's the perfect word. The value is extracted, it's extinguished, and the capital has no future function. The transaction is completely over.
Okay, so now let's look at the other side. Investing, or asset creation. This is a completely different animal.
Totally different. This is the calculated, deployed use of capital with an informed expectation of generating a future benefit.
And that benefit is usually cash flow or the asset growing in value.
Right. And an investment doesn't hit your income statement immediately like a loss. Instead, it shows up on your balance sheet. It's listed as an asset, as a source of potential future benefit.
And the cost is recognized slowly over time through things like depreciation.
Exactly, which means the asset continues to contribute value across multiple periods. The capital you deployed isn't just sitting there, it's an agent. It's been sent out on a mission to recruit or multiply more capital.
That clarity is great in theory, but, in real life, the line gets incredibly fuzzy.
Oh, absolutely.
I mean, is the new high-powered laptop an expense because it's a physical thing that loses value? Or is it an investment because it makes me way more efficient at my job and could help me earn more money? This is where I think most people get stuck.
That is the classic dilemma. And it's precisely why a sophisticated allocator needs a rigorous, objective tool to cut through that ambiguity.
So you've put together what you call the three-pronged test for classification.
Yes, and the goal here is to move you beyond emotional justification. Oh, but I need it. And into a strategic analysis for any transaction that's, above a trivial amount of money.
Okay, let's walk through it. What's the first prong?
The first is the usefulness horizon. We have to look at the expected longevity of the benefit. Is it short-lived, or does it stretch out over time?
So if the benefit is consumed almost immediately, like a meal or a concert ticket, it's spending.
Without a doubt. But if the benefit extends across multiple time periods, almost like it's being amortized like a corporate asset, then it starts to look a lot more like an investment.
What about a gym membership?
Perfect example. If you use it consistently, and that consistent use directly leads to better health, fewer sick days, more energy over, say, the next 5 years,
Then it satisfies that extended utility criteria.
it does. But if you sign up in January with big ambitions and then you stop going by February, it was just a short-term extinguished expense,
A donation to the gym, basically.
basically.
Okay, so the second prong, and this one seems trickier to me, is measurable return. Is there an honest, objective way to link a financial gain to this allocation?
Yeah, this is where you have to be really honest with yourself. Spending is so often justified by "it makes me feel good," which is a valid but unquantifiable emotional return.
It's immediate satisfaction.
Exactly. Investing, by its very definition, demands evidence. Can you actually quantify how that leadership course you took upgraded your skills?
Like, did it directly lead to a promotion or the ability to charge more for my services?
Right. Did that investment in better software tools actually cut down your workflow time, allowing you to take on one more client per month? If you can establish some kind of mechanism, even a soft one, to measure the financial uplift, it leans heavily toward being an investment.
And if the only metric is that immediate feel-good factor.
Then it's almost certainly consumption.
Okay, and the third prong, control of outcome. This sounds like it speaks directly to the strategic part of the investor mindset.
It does, because investments sit, for the most part, inside a managed strategy. You assess the risk, you monitor the outcome, and you have some way to influence the yield.
Whether that's through maintenance on a rental property or adding more capital or just managing the strategy itself.
Precisely. If you allocate capital to something purely consumptive, like, say, a lottery ticket, you have zero control over the outcome once you've bought it.
But if you invest in a business, you have management control. If you invest in your own knowledge.
You have control over the application of that knowledge. So for a transaction to be classified as a true investment, it really has to satisfy these three prongs: extended usefulness, a measurable lift, and some degree of managed control.
So if you were to run a personal P&L, a personal profit and loss statement, heavy spending would just drain your retained earnings and lower your personal equity.
Every time.
But strategic investment takes that same capital and funnels it into reshaping your asset base, so that asset base can then generate cash flow independent of you trading your time for a wage.
That's the end game.
Yeah.
It's financial independence right there.
So when we talk about that earning capacity, the main way we judge efficiency is return on investment, or ROI. The basic formula is just net profit divided by cost, and it's really the core mathematical mandate of the investor. Your capital has to multiply.
It's the universal language of efficiency. Doesn't matter if you're allocating capital to a new marketing campaign for your business or buying shares in a company, ROI is that ruthless objective test.
And if the ROI is poor, the capital could have and should have been deployed somewhere else.
Right. But the simple formula, as you know, has a huge limitation. And this is really where the sophistication begins.
It completely fails to account for the most crucial variable in all of finance time.
This is the bright line between the novice and the expert. A 20% return over 10 years is mathematically the same as a 20% return over 1 month if you're only using that basic ROI calculation.
Which is obviously absurd. The 1-month return is exponentially better.
Of course, because you can immediately take that capital and reinvest it and start compounding it. The sophisticated mindset immediately shifts to time-adjusted returns and something called the compound annual growth rate, or KGR.
Let's clarify KGR for a second, because it's a crucial acronym that I think a lot of people hear but maybe don't fully grasp. What does an investor gain by using KGR?
What KGR does is it smooths out all the lumpy, volatile returns over a period and tells you the hypothetical average rate of return you would have earned if that growth had happened at a steady, predictable pace.
So it's about the velocity of the growth.
It's all about the velocity of capital multiplication. The investor uses KGR because they're not just looking at a single transaction's total profit. They're analyzing the growth trajectory of their wealth over the long haul. It lets them value an asset not just on its immediate return, but on its potential for predictable, repeatable growth over time.
And this kind of high-level thinking brings us right into the world of corporate finance, specifically how investors value entire businesses and how ROI connects directly to these things called valuation multiples.
Oh, this is such a beautiful piece of financial geometry. When an investor buys a business, what they're really buying is its stream of cash flow, and that purchase price is usually expressed as a multiple of its earnings.
So you'll hear that a company sold for, say, 4 times earnings.
Right. So if you buy a business for 4.0 times its annual EBITDA, That's earnings before interest, taxes, depreciation, and amortization. That 4.0x multiple is just the inverse of the implied ROI.
So a 4.0x multiple means you're expecting a 25% annual return on your investment.
Exactly, 1 divided by 4. So when you see a big corporation being valued at, say, 10 times its earnings, the implied ROI for the person buying it is only 10%.
So the investor mindset is always scanning for low multiples relative to the cash flow because a lower multiple means a higher implied ROI.
Precisely. And the jargon here is actually important for context. Smaller businesses, the kind where profit is mostly for the owner, they use a metric called SDE seller's discretionary earnings. Now, because the risk is higher there, the multiples are lower, often just 2x to 4x SDE.
Which translates to an insane implied ROI of 25% to 50%.
It's huge. That's the private market demanding a very quick payback. Now, mid-sized businesses that are more established, they use EBITDA, and they trade at maybe 3x to 6x, which gives you a 16.6% to 33% ROI. The sophisticated allocator understands these benchmarks.
So they view every major purchase not as a cost, but as if they're acquiring a future yield stream that's priced at a certain multiple.
It completely reframes the purchase price. It's not about the sticker shock. It's about the efficiency ratio. It's just capital being locked up to generate a predictable return.
And we're even seeing new concepts emerge from this, like something called return on integration, or ROI.
Yes, and this is vital because it addresses synergistic returns. This is where 1 plus 1 actually equals 3.
We mentioned it briefly in our notes, but what's the actual mechanism of ROI? Why is it more sophisticated than just a standard ROI?
Well, standard ROI measures the return of a single isolated asset being deployed. ROI, on the other hand, is often used in mergers and acquisitions, or even in the world of open source research. It measures the return you get after you combine or integrate different assets or systems.
So the value is replicated and compounded through that synergy.
Exactly. Let's say you buy a training program, that's asset A. Then you integrate that new skill with a software tool you already own, asset B. If that combination lets you automate a process that saves you 10 hours a week, that massive time savings you've generated is the ROI. It's the return you get from connecting the dots, not just from acquiring the dots.
The moment we start thinking about the speed and synergy of returns, we immediately run headlong into the concept that I think truly defines the investor, this acute, almost painful awareness of opportunity cost.
Yes. The spender only sees the explicit cost, the price tag on the item.
The investor sees the implicit cost.
The explicit cost is obvious. It's the $50,000 you just spent on that highly depreciating luxury car. The implicit cost is the value of the next best alternative use of that $50,000, the one that you instantly gave up the moment you signed the papers.
This is the invisible ledger.
It is. The spender doesn't worry about it, but the investor obsesses over it because they understand that every single dollar has a job to do.
Mathematically, we define it as the return on the foregone option minus the return on the chosen option.
Which is a literal measure of your failure to optimize your capital deployment. It's a regret metric.
Let's use the classic young investor example to make this terrifyingly concrete for everyone.
Okay, so you have a young person, and they save $5,000 a year for 50 years. They're driven by safety. They're afraid of the market. So they choose to allocate all of it into low-yield 2.5% bonds.
Which feels like the responsible thing to do.
It does. And after 50 years, they have approximately $500,000. For a saver, that's a wonderful result. They feel proud.
But the investor looks at that $500,000 figure and just sees massive regret.
Yes, because the investor immediately calculates the opportunity cost.
Yeah.
If they had simply allocated half of that capital into a diversified stock market portfolio, and let's be conservative and say it yielded a 5% blended return.
Their total portfolio would be over $1 million.
Over $1 million. The price of their emotional need for safety, the price of choosing that low-risk path, was over $500,000 in lost wealth potential. The money they didn't make is a real measurable cost on that invisible ledger.
But hold on, I have to challenge that a little because someone listening might be thinking, sure, but the bond investor slept well at night, the stock market is volatile, it's risky. How does the investor mindset account for the value of peace of mind? Where is that line between smart allocation and just being reckless?
That is the perfect question because the investor mindset isn't defined by chasing the absolute highest possible return. Not at all. It's defined by making a calculated choice and being acutely aware of the trade-offs.
So the bond investor effectively paid $500,000 for peace of mind.
And the investor acknowledges that price and then asks the next question. Is there a hybrid strategy that minimizes my risk while still capturing more of that upside.
So maybe a strategy that yields 4% with defined risk parameters?
Exactly, which might still yield, say, $850,000. And in that case, you've saved yourself $350,000 in opportunity cost compared to the purely conservative approach, without taking on reckless risk. Opportunity cost forces you to pay attention to that trade-off. It forces you to optimize.
Which makes the cost of just doing nothing, especially during periods of high inflation, utterly devastating.
It really is. The source material highlights the severe opportunity cost of just holding cash, what people mistakenly see as a risk-free asset.
It's not. When you hold cash, you're effectively shorting your own currency.
Precisely. Between 2021 and 2023, high inflation meant the purchasing power of cash dropped by about 18%.
That's a huge loss.
It is. And over that same period, the U.S. stock market, the S&P 500, even after you adjust for inflation, it grew by about 6%. So the decision to stay in cash costs the saver nearly 24% in relative purchasing power compared to the investor who just put their funds in a simple index fund. That gap is the invisible ledger working against you.
So the spender sees the immediate tangible thing, the new kitchen, the big vacation, but they are completely blind to the unseen wealth that was just destroyed because that capital wasn't deployed to work.
They see money as a static resource, like a pile of chips on a table. The investor sees every dollar as a potential soldier in the army of compounding interest.
So when you spend $1 today, you're not just trading that dollar for a fleeting good.
You are metaphorically retiring that soldier. You're pulling it off the battlefield and destroying its future reproductive capacity forever. That's why allocation becomes such a serious strategic discipline for the investor. #BB. Comparative analysis of financial metrics. Table 1 deep dive.
Okay, to really hammer this mindset difference home, let's do a quick comparative analysis of the financial scorecard. The metrics are the same for everyone, but the interpretation is fundamentally different.
It's a complete paradigm shift. Let's use 4 core concepts: ROI, cash flow, net worth, and of course, opportunity cost.
All right, so when the spender looks at ROI, what's their inner dialogue?
Their inner dialogue is, did I get a good deal? Was the price I paid worth the immediate satisfaction I got? It's all focused on that initial transaction.
Whereas the investor is asking a completely different question.
A different question entirely. How efficiently is my capital multiplying? What is the velocity of this return? They're focused on the mechanism of growth, not the price of the item.
Okay, next up, cash flow. For the spender, this is about survival.
Purely survival. It's, do I have enough liquidity in my account to cover this month's bills? It's managing that month-to-month treadmill.
The investor, on the other hand, asks a generative question.
Yes. Is this asset generating passive liquidity that frees up my time? Can my assets pay for my living expenses? The entire goal shifts from just managing bills to engineering your own independence.
Net worth is probably the sharpest split between the two.
Oh, for sure. For the spender, net worth is often, irrelevant. It's an abstract number they don't track, or they might not even know what it is.
For the investor, net worth is the primary scorecard. It's the ultimate metric of successful capital deployment over a lifetime. It's the scoreboard of the game.
It is. And finally, opportunity cost itself. The spender, well, they just ignore it.
They ignore it entirely in favor of immediate gratification. They refuse to look at the alternative path.
But for the investor, opportunity cost is a critical filter. It's the gatekeeper that demands justification for every single capital deployment decision.
Yeah.
It's constantly forcing that comparative analysis. And understanding this matrix, I think, is step 1 in self-correction.
So we've laid out the math and the accounting. It all seems very logical, which brings us to the central issue. Why is adopting this investor mindset so incredibly difficult for so many people?
Because we are evolutionarily hardwired for immediate survival. That's the problem.
The war on the self is real.
It absolutely is. The transition isn't about learning a new formula. It's about actively rewiring deeply ingrained cognitive biases. We are literally programmed to prioritize the present. And that primal programming has to be consciously and painfully overridden to build long-term wealth.
And the primary psychological hurdle, the main enemy in this war, is hyperbolic discounting.
This is the bias that causes us to choose a smaller reward now over a substantially larger reward later.
The mechanism here is what's so fascinating. The discount rate, the perceived penalty for having to wait, is incredibly steep in the immediate term.
But it flattens out dramatically as the delay extends into the future. It's like your brain is trying to price the risk of waiting, and it thinks waiting even one day is incredibly risky.
Can you give us a strong analogy for this beyond the classic $100 today versus $110 tomorrow example? Something to really drill down on why that immediate window feels so painful to our brains.
Okay, think about doing your taxes. Your present self sees the pain of organizing all those receipts today as just overwhelming, so you delay it. The penalty for delaying isn't that much worse if you push it back one day or one week, which is why procrastination is so easy.
The pain of the task is disproportionately weighted in the immediate moment.
Exactly. The spender applies that same broken logic to finance. The pain of foregoing the immediate purchase is priced far, far higher than the eventual massive financial gain years down the line from investing.
And this leads us directly to the physical architecture of the brain, right?
Yeah.
Spending, that immediate consumption, it gives you a hit of dopamine.
It does. It's driven by the limbic system, the primal emotional part of your brain that's in charge of survival and immediate rewards.
Investing, on the other hand, requires discipline, planning, delayed gratification.
And that relies on the prefrontal cortex, the PFC, the seat of executive function, impulse control, and long-term planning. The spender is effectively letting their lizard brain dictate their long-term financial strategy.
So the investor is constantly using their higher-level cognition to veto the demands for instant gratification coming from the limbic system.
It's a constant exercise in strengthening the PFC's veto power. And what's scary is that the sources suggest that capacity actually declines with age.
Really?
It does. The research confirms that sustained cognitive control is really difficult. As our cognitive resources decline with age, often the motivation to delay gratification weakens. The perceived time horizon gets shorter, and the effort required to veto that immediate pleasure just becomes too great.
So it takes more energy to say no.
It takes more energy. And the Japanese studies we reviewed were fascinating. They showed that consistently high asset accumulators demonstrated very low hyperbolic discounting throughout their entire lives. It takes sustained, conscious effort to counter that biological urge for now.
And there's another huge psychological pillar here, which is how we frame resources in the first place. Do you believe the pie is finite and you've got to hoard your slice, or do you believe the pie can grow?
This is the scarcity mindset versus the abundance mindset. And scarcity operates entirely from fear. Resources are finite. Life is a zero-sum game. This is often the default setting for people under financial stress.
So the outcome is paradoxical, right? It actually leads to remarkably poor financial decisions.
It does. This is the genius of the Princeton research led by Eldar Shafir. They showed that the cognitive load of perceived scarcity, just the constant worrying about money, consumes so much mental bandwidth that it literally lowers your cognitive performance.
They actually quantified an effective drop in IQ during decision-making for people operating from a scarcity mindset. That is staggering.
It is. Your brain being preoccupied with lack literally makes you temporarily dumber about money.
And this scarcity trap leads to one of two destructive strategies.
Either you become an aggressive, fearful hoarder of cash and miss all the opportunity costs we just talked about, or you adopt an attitude of, well, I'll never have enough, so I might as well enjoy this now.
Which leads to emotional, immediate spending.
The abundance mindset is the complete inverse of this. It's the investor's core operating system. Money isn't viewed as a pile of chips, but as a tool, as energy that can be multiplied and deployed.
This fosters calculated risk-taking, not reckless gambling. It's built on a long-term horizon.
Right. The focus shifts from preservation, how much can I protect, to creation. How can I deploy this capital to generate even more value?
And the neuroscience backs this up.
It does. When subjects are primed with abundance concepts, there's enhanced activity in the left dorsolateral prefrontal cortex, the DLPFC. That's the same area we just identified, the one associated with advanced cognitive control.
So if scarcity shuts down your higher thinking and abundance primes it for growth, how hard is it to escape that scarcity rut?
Extremely difficult. The research shows that scarcity thinking is sticky. Once you're in that mode, it dampens your brain's ability to even engage with future-oriented abundance concepts. It requires aggressive, conscious effort, almost like a form of cognitive therapy, to reframe how you see resources and break that cycle of fear-based financial decisions. Hashtag Hedonic Adaptation and the treadmill of consumption.
Okay, so even if you manage to conquer the scarcity mindset, the spender has another enormous hurdle to clear, the hedonic treadmill.
Oh yes, lifestyle inflation. The moment you get the new car, that feeling of satisfaction, it just rapidly dissipates, doesn't it?
And then you need the next purchase to chase that high again.
It's the normalization of luxury. Humans are remarkably efficient at adapting to improved circumstances. That new car smell disappears, and suddenly you're just dealing with maintenance and depreciation. The spender is constantly running, trying to maintain an elevated level of happiness through consumption.
Which results in a lifestyle that costs more and more just to maintain the same level of happiness.
Right. But the sources suggest a really great escape route from this, and it's rooted in the type of spending you do.
This is the nuance. It's not just what you buy, but how resistant that purchase is to this hedonic adaptation.
Exactly. We can compare two people. Mark focuses on uniform material accumulation, a bigger house, more expensive gadgets. Then there's Maria, who invests in a wide variety of high-quality experiences, travel, unique classes, time with loved ones. Maria is far more resistant to the treadmill effect.
Because material goods depreciate both financially and emotionally, but experiences offer a memory dividend that actually persists.
That memory dividend is an asset. The utility of an experience doesn't end when the vacation is over. It compounds over time in the form of stories, deeper relationships, a broadened perspective.
So the investor, therefore, classifies certain types of consumption-varied, high-quality, memorable experiences as psychological investments.
They do, because the ROI on life fulfillment from those experiences is often superior to the ROI on yet another material object.
So to really internalize all of this, we need to move beyond the simplistic labels of just saver or spender. The sources suggest a deeper tripartite distinction to really define the allocator psychology.
I agree. The first identity is the spender. Their psychological driver is that instant emotional satisfaction from the exchange. Their identity is linked to consumption, their purchasing status, temporary comfort, external validation, all regardless of the long-term cost.
The second identity is the saver. They're driven by a need for emotional security. For them, money is a fortress, a symbol of protection.
And while they're great at accumulating assets, they often fall into the safety trap. They hoard cash that loses its purchasing power to inflation, or they struggle to ever spend the money, even when they're supposed to be enjoying retirement. They accumulate, but they fail to deploy.
And that brings us to the ultimate identity, the investor.
For the investor, the satisfaction comes from capital deployment and growth. They aren't content with just passive accumulation. They are constantly looking for the highest and best use of their resources. They accept calculated risk because they see money as energy that must be directed.
And this identity shift changes the very nature of how we allocate our emotions, too.
Absolutely. The investor engages in what we can call emotional investing. They funnel their time, their energy, and their capital into pursuits that generate long-term growth and well-being, learning a new skill, starting a side business, strengthening their health.
And they actively avoid emotional spending.
Which is that reactive depletion of resources for temporary emotional relief, stress shopping, retail therapy, you name it. The ultimate identity shift is moving from being an accumulator, like the saver, to being a deployer, like the investor.
Okay, so this shift in identity demands that we broaden our definition of an asset beyond just stocks and bonds. For the sophisticated allocator, the self is the most powerful engine of wealth creation there is. So we have to analyze how we deploy capital into our human, social, and time capital.
This is non-negotiable, especially for anyone in the early stages of building wealth. Your ability to generate primary cash flow through your skills, your health, and your knowledge is your single greatest intangible asset.
So human capital is basically the economic value that you represent to the marketplace.
That's right.
Therefore, any allocation that enhances or protects that value should be treated as a strategic investment.
This immediately reframes how we think about something like health. Poor health is a massive liability. It reduces your productivity, it increases your medical costs, and it shortens your total number of income-earning years.
So spending on health preventative care, good nutrition, fitness, it's not a luxury expense.
Not at all. It is capital expenditure, or CAPEX.
A business invests in CAPEX, a new machine, a better factory to increase its future production capacity.
And the human investor must see their body and mind in exactly the same way. And the ROI data on this is forceful.
It is. Studies on workplace wellness programs show a clear, quantifiable ROI. They show a return ranging from $1.88 to almost $4 saved for every single dollar spent.
Mostly through reduced sick days, lower insurance claims, and just higher productivity. You're not buying a gym membership, you're buying productivity, you're buying longevity, and you're buying a reduced future liability. It is maintenance CAPEX on your primary income-generating asset.
And the same logic applies to buying knowledge or skills.
Skill acquisition is R&D. When a spender sees a coaching program or a university course, they see a big price tag. They see a cost. The investor sees research and development and allocation to future capability.
Let's run the calculation on that. If you invest, say, $2,000 in a specialized course that upgrades your technical skills and that new expertise directly leads to a $10,000 raise this year, what's the ROI on that?
That's a 400% ROI, and that's just in the first year. Plus, that skill is now an asset that continues to generate returns for the rest of your career.
The distinction, though, hinges entirely on application, right?
100%. Buying the book is spending.
Yeah.
Reading the book, taking notes, practicing the new skill, and then deploying that knowledge in the marketplace, that's investing. The capital, which is the knowledge, is only realized when it's deployed to recruit more capital, which is income.
So beyond the self, we have to look at the network that supports all of our economic activities, our social capital.
Right. And the spender approaches this with low-yield transactional networking. It's a purely reactive approach.
Just handing out business cards at an event, hoping for an immediate lead or a favor. It feels like high effort, low sincerity, and very low return.
Exactly. The investor, on the other hand, engages in high-yield relationship building. This is the long game. It involves investing your time and your emotional energy with zero expectation of an immediate payback.
You're building trust, building credibility, genuinely adding value to other people's lives. You're creating what you called emotional shareholders.
And that builds a massive reservoir of social equity that you can draw upon later. And the sources gave us some great insight into the strategic roles people play in networks, specifically Nir Halevi's work on social brokers.
Right, he identified 3 types.
Yes, there are intermediaries who bridge gaps and connect different groups, which maximizes the flow of information. Then you have conciliators who mend relationships and resolve conflict. They act as stabilizers.
And then you have the 3rd type, the dividers.
The dividers, these are the liabilities. They introduce toxicity, break trust, and drain social equity from the network. The investor actively aims to be an intermediary or a conciliator, strategically building their social credit score and positioning themselves as a trusted source of value.
And the dividends from this investment, they're often intangible at first, but they manifest as real financial returns down the line.
For sure, they include access to unadvertised job opportunities, crucial inside information, and maybe most importantly, support and resilience during personal or economic downturns. These relationships are assets that prevent future liabilities and open doors that money simply cannot buy.
Okay, so the final and most precious non-renewable resource that the investor has to manage is time. Every hour is an asset that depreciates and is permanently extinguished once you use it.
That's right. The spender is constantly killing time, mindless scrolling on social media, passive consumption, low-utility activities. The investor is investing time in compounding activities.
Like learning a new skill, creating systems that save time later, delegating tasks, or building those relationships we just talked about.
And to really internalize the true cost of how you spend your time, every allocator needs to calculate their real hourly wage, or RHW. This concept, sometimes called life energy, forces a complete recontextualization of every purchase you make.
So how do we calculate the RHW? It's obviously more complex than just dividing your salary by 2,000 hours a year.
It's much more honest. The RHW is your net annual income, minus all your work-related expenses, your commute costs, professional clothing, office lunches, even the time you need to decompress after a stressful week.
And then you divide that net income by the total time you've committed to work.
Yes, including your actual hours, your commute time, your prep time. It strips away the illusion of a high salary to reveal the true cost of your life in your time.
That is powerful. It forces you to look at a purchase in terms of hours of your finite life, not just in dollars.
Exactly. If your RHW calculation reveals that you're only truly earning, say, $20 per hour of your actual life energy, then that impulse purchase, that $100 dinner, that new gadget, it's not $100. It costs 5 hours of your finite existence.
So this provides an objective emotional check on impulse spending.
It does. You have to ask yourself, is this item worth X hours of my irreplaceable life energy? This shifts the currency of your existence from dollars, which are replenishable, to hours, which are not.
Okay, we've armed ourselves with the right metrics and the right psychological understanding. But success has to be engineered. It's not something you just wish for. We need actionable systems frameworks to ensure this mindset shift actually becomes a permanent behavior.
This is where the rubber meets the road. #TechTechDay. The conscious spending versus latte factor debate.
Many people are first introduced to financial discipline through the old latte factor method.
Right. Cut out your daily indulgences, restrict all these small costs, and save the scraps. This whole approach frames wealth as the result of deprivation,
And deprivation is exhausting. It leads inevitably to what's called frugality fatigue, and then you just give up.
Exactly. The investor strategy, which we'll call conscious spending, takes a completely different approach. It views your budget as an allocation problem, not an income problem.
It's a bifurcated approach, like managing a strategic corporate budget.
It is. First, you cut mercilessly on the things that bring you no lasting value, joy, or utility. Cut the unused subscriptions, the memberships you never go to, the low CPU consumables. This is like cutting corporate overhead.
But then you spend extravagantly on your identified money dials.
Yes. These are the areas that are genuinely aligned with your core values. Maybe it's convenience or world travel, high-quality health care, or education for your kids.
So the logic is you cut the fat aggressively in order to fund your high-performance departments.
Exactly. The framework dictates that fixed strategic percentages of your income go automatically to investments first. That's reverse budgeting. This guarantees the future is funded, and then the remainder is available for guilt-free high-utility spending.
So the spender asks, how much can I potentially save by cutting?
And the investor asks, how can I strategically deploy my capital to maximize my life's value? #B, utility theory, and die with zero.
The investor mindset also provides a crucial counterpoint to the pure saver identity, especially as we look at life planning.
Yes, we have to talk about utility theory and the die with zero philosophy, which was popularized by Bill Perkins.
This sounds completely counterintuitive to the growth mindset we've been talking about. I mean, if the goal is to grow assets, why on earth would you aim to die with zero?
Because the philosophy argues that the goal is not to maximize the number in your bank account at death, but to maximize your net life fulfillment. It recognizes the utility curve of money.
Meaning that money has different value at different points in your life.
Exactly. Money has extremely high utility when you're young, healthy, and time-rich. You can travel the world, start high-risk ventures, invest in amazing experiences, but that same money has very low utility when you're 95, frail, and time-poor.
So delaying all pleasure until retirement actually destroys value because you're reducing the utility of that money.
Precisely. Those high-utility experiences are assets that pay that memory dividend we talked about. A massive high-utility trip that you take at age 35 can yield 50 years of memories, stories, and compounded perspective.
But if you delay that same trip until you're 75, you not only reduce the payout period, but you risk not being able to take the trip at all due to health constraints.
Right. So this strategy compels the investor to engage in what's called consumption smoothing across their entire lifetime, to maximize the utility curve, and to classify specific high-value experiences as necessary life investments. #C. Defensive frameworks against impulse.
Okay, since hyperbolic discounting is our constant biological enemy, we need to build systems of friction and data to combat that impulse.
Friction is the circuit breaker. The simplest and most effective tool is the 72-hour rule. For any non-essential purchase above a defined threshold, say $100 or $500 for you, you mandate a 3-day waiting period, no exceptions.
Why 72 hours specifically? What's the magic there?
That time delay is usually sufficient to disconnect the emotional stimulus, that dopamine rush in your limbic system, from the rational decision-making process in your PFC. The data on this is just unequivocal.
Decision quality improves by 43% when this waiting period is used.
And a staggering 92% of financial decisions that people later say they regret are made in under 24 hours. You are simply giving your rational brain time to catch up to your emotional brain.
And for more complex deployment decisions.
The investor removes emotion entirely by deploying the decision matrix.
So this is about bringing hard data to bear on decisions that are often really fraught with emotional bias, like deciding between saving, buying a new car, or investing in a new skill.
Exactly. You list your criteria, things like long-term value, immediate joy, liquidity impact, maintenance cost, and then you assign weights to each of those criteria based on your overall life goals.
And by scoring each potential option against those weighted criteria, the resulting score immediately overrides that impulse for immediate gratification.
Right. In our source example, the high immediate joy score of buying a new car just couldn't compete with the long-term high-weighted scores of a market investment or a skill course. The data dictates the allocation, not the impulse.
And finally, we have to build systems because willpower always fails eventually. The investor engineers their success through automated flows.
This is key. We mentioned it earlier, but let's really look at the operational flow of reverse budgeting, or pay yourself first.
This is the anti-saver method.
It is. Instead of trying to save whatever is left over at the end of the month, which is usually nothing,
We're not enough.
the investor automates their capital deployment. And the flow is critical. First, an auto transfer to your investments. Second, an auto transfer to your savings for liquidity buffers. Third, you pay your fixed costs like rent and utilities. And only then, whatever is left is for guilt-free spending with the remainder.
This forces your current lifestyle to adjust to the artificial scarcity you've created in your checking account. It guarantees your future self gets paid first.
Right. Another essential metric that moves you beyond the price tag is cost per use, or CPU.
This is the total cost of an item divided by its estimated lifetime uses.
It's the foundation of the buy it for life philosophy. The spender focuses on the lowest price tag. The investor focuses on the lowest CPU.
So a pair of high-quality $300 boots that you use 500 times is $0.60 CPU.
Whereas those trendy, cheap $50 shoes that fall apart after 2 uses have a CPU of $25. The investor is willing to pay a higher upfront premium for items that depreciate slowly and have high durability because they recognize that quality is an investment, while cheap goods are just immediate consumables.
And finally, this all comes down to the investor routine. It's not just about the big money decisions. It's about the daily habits that support this entire cognitive architecture.
The routine is designed to maintain the strength of that prefrontal cortex. It means continuous learning, modeled by people like Warren Buffett, who famously spends 80% of his day just reading to compound his knowledge.
It involves morning priming exercise, meditation, planning to actively engage the PFC before the day's stressors can hit.
And most critically, it's about emotional regulation to prevent your limbic system from initiating a panic sale during a market downturn or an impulse purchase during a period of high stress. The quality of your allocation decisions is a direct reflection of the quality of your daily routine. #tag outro. So we've broken down this allocator's dilemma from its neuropsychological roots all the way up to its highest financial frameworks. And the difference between the two mindsets is, I think, fundamental. The spender mindset is linear and reactive. It's about trading your time for money just to maintain consumption. It's strapped in the immediate present, focused only on the scene utility.
But the investor mindset is exponential and proactive. It views all resources, money, time, knowledge as seeds to be planted, building assets that compound and generate value independent of your direct labor.
So let's just quickly review the core shifts you have to adopt starting today. Move your focus from price to value using that cost per use metric. Stop asking if you can afford something and start asking if this is the best allocation of your capital compared to all the other viable alternatives.
And shift from viewing financial discipline as deprivation to viewing it as strategic selection. You're cutting overhead to fund your high-performance needs.
And finally, you have to internalize that today's linear sacrifice is the seed of tomorrow's compound, exponential gain.
The profound realization after this whole deep dive is clear to me. Spending provides the illusion of wealth through the temporary accumulation of things. Investing provides the reality of wealth through the accumulation of options, time, and freedom.
Right. The investor doesn't aim to die with the largest bank account, but with the optimal mix of utilized resources and maximized experiences. They win the game of allocation because they treat money not as currency to be consumed, but as capital to be deployed.
So we challenge you to consider this as you go forth and allocate strategically. Stop asking, what can I buy with this money? And start asking, what can this money build for me? Look critically at your current routine. Which of your daily expenses, when viewed through the lens of human capital, are actually the weakest investments in disguise? And what asset could you build by reallocating that energy? Go forth and command your army of capital.